Joining us next is our very own Alex Chan, Western Canada Regional Wealth Leader, IDC Worldsource. Alex has been in the financial services for over 30 years, directly out of Simon Fraser University, and has worked in all areas of the business. He currently holds 7 professional designations and has been involved in training, developing, and supporting advisors for many years. Alex is based out of Langley, BC, and works with advisors associated with our BC and Prairie regional offices. He resides in Burnaby, BC with his wife and their 2 boys who are currently studying at Simon Fraser University. Please join me in welcoming our very own Alex Chan. Alex, take it away.
Excellent. Thanks again, Greg, for that very kind introduction. And as Greg mentioned, I'm Alex Chan, and I think I've met most of you on this call, the Regional Wealth Leader for Western Canada. I work very closely with Graham Allen, our Wealth Leader for the East, Vic Ray, our National Director of Banking, who you hear from tomorrow, and of course, Jason Payne out of the Maritimes. And Jason is the Head of Wealth and Banking for Canada. So my title today, 2021, record-breaking year for investments at IDC WIN. And I'm going to talk about the top 10 opportunities that were in front of us in 2021 and what we foresee will be continuing in 2022. At IDC Worldsource, we've always said we have the opportunity of working closely with our top advisors right across Canada. So we have the pleasure of actually seeing what our top advisors do, what works, what doesn't work. So definitely after my presentation today, please reach out to the RVP that you deal with, your BDE, myself or Graham or Greg or whoever you're working with to talk more about these opportunities in front of us. So no particular order, we have actually come up with a top 10 opportunities that actually brought in substantial wealth sales to IDC Worldsource in 2021. And we feel that these will continue going forward in 2022. And I'm going to spend about 2 minutes on each of them. And actually some of them are a presentation within themselves, but I'm going to talk about real estate, QROPs, commuting defined pension plans, business and farm sales, which have generated a lot of opportunities, intergenerational wealth transfers and inheritances, corporate borrow to invest strategy, which was actually a presentation we did a few months ago. I'm going to talk about the GMWB marketplace, which is still strong in Canada. And we still have 3 companies in that marketplace. IPPs have reemerged once again, so a lot of interest there. And I'm going to talk about the GIC marketplace and how to tap into that. And also follow the cash, 320 billion reasons why. But first of all, I want to show you all where IDC WIN stands in the marketplace and the substantial opportunity out there. Today, there's $140 billion in Canadian seg fund AUA, and that's a stat from Investor Economics, and the last numbers was from November, so hopefully that will, you see a big increase for December. At IDC Worldsource, we actually manage, we actually manage 8.5 billion in assets under administration. And again, thank you for all of our advisors on the call for that substantial business. And if you were to include our GIA assets and group retirement, that is actually 8.9 billion. And to give you an idea of where we stand as an MGA, if IDC WIN were an insurance company, we would be rated number 6 in Canada just behind Empire Life, who is at just under 9 billion of assets under management. But I also wanted to show you what all of you out there did in 2021, which is unbelievable. Again, we all thank you for that massive seg fund business that was achieved in 2021. And that's $1.24 billion in new deposits. So thank you once again for that. So real estate sales, and again, these are in no particular order. There's been record high real estate prices across Canada, especially in BC and Ontario. And real estate has produced substantial wealth for many ordinary Canadians, and also massive wealth for real estate developers and investors. And those of you that joined my webinar last week, I did do 2 cases on real estate developers and the huge opportunities they brought forward. And many in real estate have taken profits. And after taking profits, they actually want to diversify into a more outsourced, managed, and less hands-on investment, such as segregated funds as they near retirement. Because those of you that do invest in real estate, you know it's very rewarding, but at the same time, it is a lot of work. So large sums of money from these products have been earmarked to the next generation. So naturally, seg funds with privacy, estate cost savings, a quick payout seem to really resonate well in that marketplace. The second one is the QROPS, Qualifying Recognized Overseas Pension Scheme. And that word scheme, I know here in Canada doesn't sound that great, but it's actually a UK term. And again, QROPS is a great opportunity out there. Today, it's only available with IA, segregated funds. And believe it or not, there are many former residents of the UK who are now living permanently in Canada with pension funds that are still in the UK, and they have no intention of moving back to the UK. So you can transfer those pensions over here to Canada. The incoming transfer will be free of any UK taxes. And once the pension is deposited to IA, the plan is registered, so it will continue to grow tax deferred. So a few rules: you must be 55 or older, and you must plan on residing in Canada for the next 5 years. Now, this is virtually an untapped market, as QROPS was not available for almost a decade. For those of you who remember the old Standard Life did work in the QROPS marketplace. But fortunately, IA has reintroduced the opportunity for QROPS once again. IA brought it back to the market about 2 years ago. And the benefits for transferring these pensions are, of course, a reduction of tax liability at their retirement, and also increase investment options with a greater growth potential, because yourself and your clients have control of the money. And these QROPS cases generally bring in about $250,000 to $750,000 in assets. So it's a great little market to work in. And also, staying on the pension theme, commuting defined benefit pension plans has again been a great opportunity here in Canada due to mergers, acquisitions, employment change, downsizing of business, terminated employees. And when this happens, they're usually presented options. And one of the options is they are allowed to commute their DB pensions. So clients that have commuted successfully their DB pensions cite a few main reasons time and time again. Believe it or not, one of them, they question the financial stability of the company, and sometimes the company managing and holding the pension funds. And although it's never really an issue of the company managing the funds, it's their perception. So again, if you go along with it, you can definitely convince them to commute their pension. If they're terminated, bought out, or laid off, they usually want to get their money out yesterday. So they want to, get their pension out of the company that they've been terminated from. And this provides all the advisors on the call today opportunity to assist in planning based on their RSP room, TFSA room. Some of the commuted pensions have a cash payment. And of course, most of it does transfer into a LIRA. And once commuted, going forward, there's a lot more flexibility, investment options, potential for growth, and also more control over survivor options and beneficiary options. And you will hear them say they want more control of their money. And there is also an option for a copycat annuity. So for those clients that want to stay with something that's guaranteed with a life annuity, definitely a copycat annuity is available. And in this marketplace, definitely reach out to myself or Graham Allen in the East. And we'll help you do the analysis on whether or not it's a good deal for your clients to commute or not to commute. And the fourth area that has been bringing in large deposits to IDC WIN is with business and farm sales. Farms have been selling for record prices right across Canada per acre, and it's oftentimes due to large conglomerates or land barons who have been buying up farms for future development or to create larger economies of scale in some of these large national and international farming companies. And sadly, sometimes farms are sold simply because the next generation, they want to choose a career and they don't want to be a farmer, which is unfortunate. So it usually results in the parents selling the farm. And net proceeds for the farmer's sale are typically passed on to the next generation. And this marketplace, I believe, because they, worked off the land, they are also very interested in environmental, social, and governance, shortened to ESG investing. And seg funds that you recommend will help these farmers plan their estates accordingly and with privacy. And life insurance is also an excellent tool in this market for estate equalization between family members. And on the business side of it, businesses are also being sold to competitors or national consolidators in order to grow market share. And we found that many of these older, more established businesses also sit on very valuable real estate across Canada. And businesses and the property that they sit on oftentimes will yield millions and sometimes tens of millions of dollars. And again, presenting huge opportunities and more opportunities for estate planning with seg funds. Intergenerational wealth transfers, again, we're in the early stages of this, estimated at 1 trillion plus. And this is one of the reasons why seg funds have grown to $140 billion industry. And oftentimes with wealth transfer, the money sometimes skips a generation and goes to the grandchildren. And the wealth transfer also opens up the door for charitable gifting planning with seg funds, annuities, or life insurance. And ESG seg funds, once again, a popular choice in this market. And sometimes extended families and multiple marriages come into the picture. And with 100% death benefit guarantee, privacy, cost savings, and a quick payout, there's some of the key features of seg funds that really resonate with wealth transfers. Children and grandchildren of top money clients, they actually should be brought into discussion. In order for all advisors to preserve the wealth on your books when the clients pass and that money transfers, so you have a connection with the next generations. And also for potential new clients, we should all be ready when the beneficiaries of large estates, they will start to interview new advisors, so you can all position yourself to be on the receiving end of the intergenerational wealth transfer. Seg funds, they can be a lot more cost effective in this marketplace than setting up a formal trust. And again, I'm going to quickly review the 10 unique features associated with seg funds at the end of my presentation. Corporate borrow to invest. We did a presentation on this as well with Vic Ray a couple months ago. And again, this corporate borrow to invest is ideal for incorporated professionals or incorporated small business owners who have a 10-year plus time horizon, great cash flow, strong retained earnings, and they're comfortable in taking on good debt and somewhat experienced investors, and they understand the equity markets. Many business owners, they've built up significant retained earnings in their corp, and they're always looking for ways to pull them out as opposed to salary or dividend, which of course attracts the highest tax rates. Some small business owners no longer invest within the corp, or they limit their investments in the corp to stay below the 50,000 passive income threshold. That of course affects the small business deduction, the SBD. For every dollar over, it does reduce the SBD by over $5, so it is substantial. So the incorporated small business owner or incorporated professional, in this strategy, they personally apply for the investment loan with IA, B2B, or Manulife Bank. And of course, Vic Ray, our national director, or myself or Graham can help direct you as well. The seg fund account is held personally, therefore it also offers potential for creditor protection. The company pays the owner an amount equal to the interest of the investment loan, which is taxable, but the interest repaid by to the bank by the individual, it is tax deductible interest payments. So the result of this concept is actually no taxation on funds that are pulled out of retained earnings. The corporation essentially funds a leverage investment that will grow to supplement the retirement needs of the incorporated professional or small business owners. Accountants love this strategy for their clients as it is tax driven and it does untrap corporate surplus. GMWB market, which of course Manulife brought out decades ago with the Income Plus product, is still alive and strong, still available with 3 companies, Empire, IA, and Sun. And again, the GMWB is a great alternative for GIC and GIA clients because you can offer them guarantees. A portfolio base of a GMWB and an annuity can provide an excellent guaranteed base income that will be there as long as your clients live. And it's always protected from market turndowns, and it will continue even if the value of the investments go to zero. So a very compelling story for the GMWB market. For those clients that want to build themselves a personal pension, guaranteed income at a later date, the 4% notional bonus is still offered exclusively with Empire Life, their Class Plus 3. Individual pension plans, IPPs, with the small business passive income rules that came effect in 2019. Accountants and small business owners and incorporated professionals have started to consider IPPs once again. And of course, IPPs, they offer a higher total contribution room than RSPs, and this will increase with age. Ideal target market, clients 40 plus, T4 incomes, they have to be employees. and of course 100,000 or more. And there is a past service contribution when implemented, and this can be very large as well. Contributions are 100% tax deductible for the company for the funds going into an IPP. And IPP generally can generate large sales for you, sometimes in excess of $1 million. And again, work with Graham or myself and one of our partner actuarial firms or the life companies to prepare a proposal. And again, IPPs can be an excellent prospecting tool to offer a very unique and niche product. And I found IPPs can lead into estate planning opportunities for non-reg portfolios, as well as permanent life insurance needs. Converting GICs to GIAs to seg funds, a huge market here. So never say to your clients, just go to your bank to buy GICs. You should actually promote one of the life insurance companies' GIAs and transition them into seg funds. GIAs are identical to GICs, and they have tax and estate planning benefits of a seg fund and also with guaranteed interest. In this market, larger deposits, 500,000 or more, reach out to Graham or myself because we can usually get a special quote from one of the life cos that generally can beat the best published GIC rates in the market. And they also can be enhanced by 20 to 25 bips through compensation reduction. Not that we endorse you to do this all the time, but if you have top clients or you want to attract money in the door, that can further enhance the rates. And once GIC clients become GIA clients and you do a lot more planning for them, you will find out that clients are trying to live off the interest, but yet they want to pass the GIC to the next generation. So in lieu of a GIC or GIA, you can show them perhaps a conservative portfolio with a SWIP running, which is a lot more tax efficient, with a combination of withdrawal of principal, dividends, capital gains, compared to interest income, which is of course at a higher tax rate. Again, GMWB portfolios work well in this market for clients that are so used to having guarantees. And also there's one unique product that we've seen a lot of interest in across Canada. We actually have a seg fund market-linked GIA with Desjardins exclusively. And the last one, look for the cash. There's estimated $320 billion of cash out there sitting in checking, savings, as I say, sometimes under the bed or in a safe in the wall. Ask your clients, what do you plan to do with the cash? You know, travel, invest, pay off mortgage, debt, help family, or leave it for your family. And if they plan to leave this for their family, you can introduce estate planning with seg funds, and of course, possible life insurance opportunities. If anything you learned from my presentation today, this is a question that I've coached advisors to ask clients quite often. Ask your clients this question: what portion of your liquid cash investments net worth will you never spend? Is it 10, 15, 25%? Whatever the answer, these funds can be earmarked for seg funds or par or permanent insurance for the next generation. And again, I'm just gonna finish up my presentation on just these quick 10 best features of seg funds, the features and benefits. I'm not gonna go over them. Actually, Graham and I have a full presentation on these features as well. So once again, thank you, and thank you, Greg. Back over to you.